Imagine a time when every stock transaction involved shouting on a trading floor and physically exchanging paper. The pace was human, limited by voice and movement. But then, something shifted, dramatically accelerating the world of finance. The early push towards electronic trading was primarily driven by innovations in telecommunications and early computing systems, particularly the adoption of ticker tape machines, teletypewriters, and rudimentary electronic order matching systems. These technologies were crucial because they tackled the inherent slowness and error-proneness of manual trading. Ticker tape machines, first introduced in the mid-1800s, provided near real-time price quotes from the exchanges to offices for away. This was a radical departure from waiting for newspaper updates. Teletypewriters, which emerged later, allowed for direct, text-based communication between brokers and the exchange, bypassing phone calls or runners. This streamlined order placement and confirmation. Furthermore, the development of early mainframe computers in the 1960s and 70s enabled the initial steps towards automated order matching, taking human intervention out of the direct execution path and replacing it with programmed logic. The objective was clear: reduce delays, increase accuracy, and handle a higher volume of transactions efficiently. For market participants, this meant a tangible increase in speed and reach. A broker in a distant city could receive price updates on their ticker machine almost instantly and then place an order via teletypewriter, knowing it would be processed much faster than ever before. These systems laid the groundwork for centralized, electronic marketplaces, replacing the need for every transaction to happen physically on a single trading floor. This allowed for greater market access and the ability to process more trades within a trading day, which was essential as transaction volumes began to rise. A prime example of this evolution was the National Association of Securities Dealers Automated Quotation System, or NASDAQ, launched in 1971. This was not initially a fully automated exchange, but an electronic bulletin board that displayed bid and ask prices from different market makers. It used dedicated computer terminals and communication networks, moving away from physical paper slips and verbal agreements. While still requiring human intervention for actual trade execution at first, it proved the immense efficiency of electronic information dissemination. Ultimately, these foundational technologies transformed financial markets by democratizing access to pricing information and accelerating the transaction process. They paved the way for the sophisticated, high-speed electronic exchanges we know today, forever changing how assets are bought and sold globally.